Cell 1. In this cell, we're delving into the important concepts of agency costs and marginal utility, both of which are critical for understanding why decisions in the business realm often go awry. These concepts help us distinguish the underlying issues behind various failures, such as poor returns or increased risks, each requiring tailored approaches for resolution. To elaborate, agency costs arise from a disconnect between the objectives of a principal. Think of it as the owner or shareholder, and those of an agent, like a manager or employee. This misalignment can lead to decisions that harm the overall value of the organization. On the other hand, marginal utility focuses on the incremental benefits gained from consuming one additional unit of something, which tends to diminish as more of that unit is acquired. Understanding this can help us gauge whether additional investments or actions will yield value, or if they might just be unnecessary additions. In practical terms, agency costs help us identify misaligned incentives that may detract from creating value, while marginal utility prompts us to consider the efficiency of our actions in relation to their benefits. Recognizing these distinctions is vital for effective decision-making in business contexts. We need to be mindful that failing to address either aspect may lead to misguided strategies. Now, as we look ahead to the next cell, we'll explore 3 real-world examples that illustrate how these concepts manifest in contemporary business scenarios. This will deepen our understanding and provide practical insights into their application. Cell 2. In this cell, we are simulating the complex dynamics of sales commissions and their impact on both sales performance and potential risks such as refunds. This is important because it helps us visualize how a firm's commission structure can inadvertently lead to overzealous selling tactics, which increases the likelihood of refunds, essentially, agency costs that can harm the principal's profits. The first key element here is the simulation of effort, represented as hours worked per week. We generate random values to represent effort levels and then use these to calculate sales. This relationship illustrates diminishing returns, meaning that as sales reps put in more hours, each additional hour becomes less effective in generating sales. To model this, we apply an exponential function influenced by a constant represented by K, which adjusts how quickly sales saturate as effort increases. Next, we establish a commission rate to incentivize aggressive selling. However, this brings us to the crux of the issue. While sales might initially rise with effort, the increased pressure to sell can lead to complications, including higher refund probabilities. The agent continues to earn commissions regardless of eventual refunds, putting all financial risk back on the principal, which is what we term as agency cost. We simulate refunds using a logistic function that takes into account both sales and effort above a certain threshold, indicating that as sales increase, so does the chance of refunds. This can significantly impact the principal's profit, leading to scenarios where higher sales don't necessarily equate to better financial outcomes. Finally, we categorize and analyze our data into bins that allow us to examine average values across different levels of effort. This way, we can clearly see how marginal utility diminishes and how agency costs might rise concurrently. The correlation checks at the end further deepen our understanding by highlighting relationships between effort, sales, refunds, and profits. As we continue to the next cell, we may delve deeper into interpreting these relationships, exploring how a firm can strategically manage commission incentives to mitigate risks and enhance overall profitability. Cell 3. In this cell, we're diving into the dynamics of sales commissions and how they interact with agency costs and diminishing marginal returns from effort. This analysis is crucial, as it helps us understand the trade-offs between the effort agents put in and the resulting sales they generate, which ultimately impacts their profitability and utility. The cell starts by setting up the framework to simulate outcomes based on varying levels of effort agents might exert each week, ranging from 20 to 70 hours. An important aspect of this simulation involves calculating expected sales while accounting for randomness, which we model through a normal distribution. Here, we see that sales are influenced by a maximum threshold, and the logic also incorporates a commission structure to derive agent earnings. To get a more granular understanding of the sales process, we introduce a refund probability that increases as sales grow, reflecting potential inefficiencies or pressures within the agency channel. This probability is modeled using a logistic function, and from there, we calculate the associated costs of refunds, which are critical for determining the principal's profit. Given that agency work can be taxing, we also factor in an effort cost that reflects the fatigue agents may experience based on the hours they work. This introduces a level of complexity as we aim to assess how this effort impacts the agent's utility, calculated as their commission minus the effort costs. Each simulation run for different effort levels provides us with a comparative dataset. From this, we identify key optimal points for both the principal and agent. Alongside metrics like agency costs and a diminishing returns index, which highlights how profit changes with incremental efforts. This is particularly relevant when evaluating efficiency in sales strategies. The results are not just numbers. They speak to the inherent trade-offs that exist within commission-based work. The plots we generate encapsulate expected sales, principal profit, and agent utility visually, allowing for a more intuitive grasp of how effort translates to performance. Lines representing optimal effort levels help clarify where agents can maximize their utility without disproportionately increasing costs. Moving forward, the next cell will likely build upon these insights, perhaps exploring in greater detail the implications of these findings or introducing further complexities to the model. This foundational analysis sets the stage for understanding how agents and principals can align their efforts for maximum benefit. Cell 4. In this code cell, we're creating a dynamic visualization to explore the concept of diminishing returns in the context of agency costs and agent utility. The addition of a slider control allows users to manipulate the parameter K, which influences how quickly sales saturate as effort increases. This interactive approach helps in understanding the nonlinear relationship between effort, sales, and profitability. We start by establishing a grid of possible effort levels, ranging from 0 to 100, which allows us to model various scenarios without overwhelming complexity. The base parameters, including maximum sales and the commission rate, are predefined to set our initial conditions. Effort incurs costs that are linear and quadratic, reflecting both direct expenses and increased complexities as effort rises. The higher the effort, the greater the costs involved. The function expected curves is crucial because it calculates 4 important outcomes: expected sales, expected profit, expected agent utility, and the probability of refunds. Each of these calculations hinges on the sales curve, which reflects diminishing returns as indicated by the parameter K. As we adjust K using the slider, we can see how this parameter changes the shapes of our curves in real time, illustrating how different levels of effort impact sales and agent outcomes. The frames of our Plotly figure allow us to create an animated switch between different values of K, providing a vivid representation of changing dynamics. Each frame updates the visual output as the user interacts with the slider, making the data not just static, but dynamic and engaging. The expectations around commission, profit, and utility are constantly recalibrated, with the refund probability also factored into expected profitability. It's important for learners to note that while our approach is deterministic, it simplifies real-world uncertainties, where sales can be less predictable. This model relies heavily on mathematical assumptions about linearity and convexity, so any deviations in real scenarios might not follow these neatly curved paths. As we progress into the next cell, expect to delve deeper into further model refinements or alternative visualizations, expanding our grasp on agent economics and the nuanced impacts of varying effort levels. This isn't just an academic exercise. It's a practical tool for understanding how varying factors influence business decisions. Cell 5. In this cell, we explore the intricate dynamics of fund manager risk-taking and how it interacts with the diminishing utility of wealth faced by investors. Understanding this relationship is crucial, as it provides insight into potential misalignments between the interests of investors and fund managers. To begin, we simulate two distinct investment strategies that a fund manager might employ: a conservative approach, which yields lower returns with less volatility, and an aggressive strategy that, while potentially offering higher returns, carries much more risk, including the possibility of significant losses. The simulation employs random choices to assign each of the 1,000 observations to one of these strategies, establishing a realistic framework for analyzing outcomes. Subsequent calculations determine the expected returns and risk associated with each strategy. The returns are generated using a normal distribution tailored for each strategy's mean and volatility. Notably, we introduce a crash risk for the aggressive strategy, reflecting the real-world phenomenon where high-risk assets can lead to severe downturns, further complicating the decision-making landscape. Next, we assess the investor's utility by utilizing a log utility function, which captures the diminishing marginal utility of wealth. This means that as wealth increases, each additional dollar brings less incremental satisfaction to the investor. We start with an initial wealth amount and apply the computed returns to evaluate the final wealth, ensuring that we don't allow wealth to drop below a certain threshold. The compensation structure for the fund manager is also critical. Managers have a base salary, but they receive a substantial bonus if their returns surpass a specific threshold. This creates a strong incentive for aggressive risk-taking, potentially at the expense of investor utility, which we analyze closely in this cell. To summarize the findings, we group the data by strategy and compute the mean and standard deviation of returns, investor utilities, and manager pay. This aggregation allows us to visualize how the choice of strategy impacts not only the manager's compensation, but importantly, the investor's well-being as indicated by their utility. As we look at the results, we can see the underlying dilemma. The strategy that maximizes the manager's pay is not necessarily aligned with what optimizes the investor's utility. This highlights a classic agency problem in finance, where misaligned incentives can lead to decisions that favor one party over another. In the subsequent cell, we'll delve deeper into these results, exploring potential remedies to align interests more closely, perhaps looking into alternative compensation structures or risk management strategies to bridge the gap between the parties involved. This examination provides a pathway to better understand how to harmonize incentives in finance, ensuring both managers and investors can thrive. Cell 6. In this cell, we're diving into the dynamics of risk-taking behavior for fund managers, contrasting agency costs with the diminishing marginal utility of wealth. This is a crucial area of study because it highlights how different strategies can lead to varying outcomes for both investors and managers, influencing our understanding of optimal behavior in financial contexts. To illustrate this, we start by simulating two distinct investment strategies: conservative and aggressive. The cell generates returns based on these strategies, with specific parameters for expected returns and volatility tailored to each approach. For the aggressive strategy, we even incorporate scenarios where unexpected market crashes might occur, introducing an additional layer of realism. The simulation then moves forward to calculate how these returns affect wealth over time. With a starting wealth of $1 million, we observe wealth growth after accounting for returns, applying the logic of diminishing marginal utility through a logarithmic transformation. This is key because it reflects how investors value wealth differently as they accumulate more. Next, we analyze the compensation structure for managers, focusing on base pay and potential bonuses that hinge on those returns. By examining the expected pay and the utility derived from these wealth increases, we can compare the interests of the manager and the principal investor. This leads us to derive important metrics like the certainty equivalent, which serves as an indicator of the comfort level for investors compared to the actual expected wealth. One notable output is the computation of the agency cost percentage, illustrating how the strategies diverge in terms of maximizing expected utility versus maximizing manager pay. We also calculate a risk-penalty fraction, revealing the impact of diminishing marginal utility on risk-taking. This aspect sheds light on how the concavity of the utility function penalizes risk, helping to frame our understanding of investor behavior in the presence of risk. To visualize these findings, we create several impactful plots. The first histogram illustrates the differing return distributions, clearly showing that the aggressive strategy tends to have a fatter left tail, a visual representation of the associated risks. Additionally, we produce bar charts that compare manager pay with investor utility and depict the calculated risk penalty across both strategies. As we transition to the next cell, we'll continue exploring these concepts, building a deeper understanding of how these dynamics evolve and what implications they may hold for investment strategies and outcomes. Cell 7. In this cell, we explore a scenario that illustrates the conflict between an agent's desire for larger budgets and a principal's focus on return on investment. The central theme revolves around the concept of agency costs and diminishing returns to budget expenditures. By modeling several projects with varying budget requests, we can quantify both the value created and the surplus generated, which helps us understand the behavior of agents under different conditions. The process begins with generating budget requests for a set number of projects. These budgets are random values uniformly spread between $1 and $50 million. Next, the true project value is determined using a logarithmic function that reflects diminishing returns, incorporating some random noise to simulate real-world variability. This means that as budgets increase, the incremental value derived from additional spending decreases. We then define two important variables: the surplus for the principal, calculated as the project value minus the budget, and the utility for the agent, which includes a component reflecting their preference for larger budgets, often referred to as empire building. This utility also includes a term for their concern about project success, albeit to a lesser extent. Moving on to our analysis, we identify the projects that yield the maximum surplus for the principal and the maximum utility for the agent. This comparison highlights how the optimal choice for the principal may differ dramatically from that of the agent, illustrating the inherent conflict between these two stakeholders. To further our understanding, we calculate the marginal value generated per $1 million spent on the budget. This analysis is crucial because it shows how the benefits of added budget diminish as spending increases, reinforcing the concept of diminishing marginal utility. As we wrap up this exploration, we can anticipate that the next cell will build on these findings by delving deeper into the implications of agency costs on project selection and resource allocation strategies. This discussion will be critical for understanding how to align the interests of agents and principals more effectively, thus driving better decision-making and enhancing overall project outcomes. Cell 8. In this cell, we're diving into the intricacies of budget allocation with a focus on agency costs and the diminishing returns on investment. Understanding how to balance these elements is crucial for firms that want to optimize both their investments and the benefits they derive from them. To begin, the code generates a series of budgets ranging from $1 million to $50 million to analyze how varying amounts of expenditure affect overall value. The model incorporates a logarithmic function that describes diminishing returns. As we increase the budget, the additional value gained from each dollar spent decreases. This is important because it underscores a fundamental economic principle. More spending doesn't always equate to proportional gains. The next step in the analysis is to calculate the principal surplus, which serves as a proxy for the net benefits experienced by the principal or agency. This surplus is derived by subtracting the budget from the value obtained, allowing us to gauge how effective the spending is for the agency. On the flip side, we also compute the agent's utility, which accounts for their private benefit from scaling operations. By analyzing both perspectives, we can see how each party perceives the value of expenditure, A key aspect here is identifying optimal budgets for both the principal and the agent. The code highlights the budgets where each group's objectives are maximized. The variables derived from this analysis, like agency cost percentage, provide insights into the efficiency of budget allocation compared to the maximum potential surplus. After establishing the theoretical groundwork, the cell generates two dynamic visualizations using Plotly. The first visualization illustrates the relationship between budget, value, principal surplus, and agent utility. It features dashed and dotted lines marking the optimum budgets for each party, making it visually intuitive to grasp where these conflicts or alignments occur. The second plot focuses specifically on the marginal value, showing how it declines as the budget increases, reinforcing our understanding of diminishing returns. Looking ahead, the next cell will likely build upon these insights by further exploring how different budget strategies can be formulated to maximize overall efficiency while minimizing agency costs. This not only reinforces our understanding of the theoretical principles, but also has practical implications for real-world budget management. Cell 9. In this cell, we're diving into the creation of an interactive visual representation of budget dynamics in relation to value generation, principal surplus, and agent utility. This visualization will help us better understand how different levels of budget impact these key metrics, making it easier to derive insights from the data. The workflow begins by defining a budget range, which serves as the foundation for further calculations. With a method for generating expected curves, we compute the value derived from each budget allocation using logarithmic scaling. Key metrics, like principal surplus and agent utility, are then calculated from this value, providing insights into how effectively resources are utilized and the benefits accruing to agents involved. The diagnostics function is crucial, as it identifies the budget points where principal surplus and agent utility peak, allowing us to understand optimal spending levels. We explore varying the curvature of value response by looping through a specified range of parameters. This creates multiple frames for our animated visualization and helps illustrate how these relationships shift with different assumptions. As we build up each frame, we ensure that the relevant lines indicating peak values are recorded for each configuration. The use of Plotly enables a seamless animation that enhances our understanding of how budget allocations affect outcomes in real time. This not only clarifies the trade-offs between value, agent utility, and surplus, but also allows users to explore different scenarios through an interactive slider. Finally, we construct the layout for our figure, adding elements like axes titles and margins to ensure clarity and usability. By keeping the sliders at the end, we prevent any unintended styling conflicts, guaranteeing that our interactive elements are functional and user-friendly. Looking ahead, the next cell will likely build on this foundation, potentially introducing more complex simulations or analyses that could further enrich our understanding of budget constraints in various scenarios. This progression will enhance not only the insights drawn from the current visualization, but also provide a deeper exploration into the underlying economic concepts. Cell 10. In this cell, we're diving into the diagnostic framework that helps us understand the inefficiencies and outcomes and the underlying causes. This insight is crucial for both leaders and organizations, as it allows them to pinpoint whether issues stem from misaligned incentives or the inherent limitations of additional resources. We begin by identifying two classic failure modes: agency costs and diminishing marginal utility. The former refers to situations where individuals or agents prioritize their own interests over the collective good, which can lead to inefficiencies. On the other hand, diminishing marginal utility highlights a scenario where adding resources produces less incremental value, even when incentives are perfectly aligned. Understanding the distinction between these two aspects is essential. Failing to separate them may lead to misguided actions. For example, if a firm blames poor outcomes on misaligned incentives when, in fact, economic reality limits effectiveness, it risks punishing agents unjustly. The narrative continues as we explore how leaders often respond to flattened performance by increasing bonuses or raising targets, without fully understanding the root cause. This could signal a lack of engagement from employees or reveal that additional effort yields diminishing returns. We also examine the pitfalls of equating risk-taking with productivity, particularly in fields like finance, where aggressive actions might mask underlying inefficiencies. Key considerations emerge, such as deciding when to delegate or centralize decision-making. While decentralization may foster innovation when marginal utility is high and agency costs are low, organizations must be careful as utility declines. Misalignments become increasingly costly, advocating for more centralized oversight during times of diminished returns. Moving forward, these insights can significantly influence capital allocation and funding decisions. Without a clear distinction between diminishing returns and agency costs, organizations risk overinvesting in low-yield projects or supporting initiatives that don't drive actual value. Finally, as we shift toward policy design and scaling, recognizing how utility declines and agency costs grow with complexity is vital for sustainable growth. The next cell will delve even deeper into practical strategies that can be employed for improvement, focusing on real-world applications of this diagnostic framework. Cell 11. In this final cell, we're wrapping up our exploration of the project, signaling the completion of our analysis or computation. This is where we take a moment to reflect on everything we've accomplished, ensuring that we've covered all the necessary steps and produced our desired outcomes. As we conclude, it's important to think about the implications of our findings. By summarizing what we've done, we can reinforce the learning objectives and key insights gained throughout the notebook. This includes revisiting important variables that we have manipulated or analyzed in previous cells, drawing on the connections between them and the overarching themes of our work. What stands out here is the significance of clear communication of results. This part isn't just about completing the coding. It's about understanding how these results fit into a larger narrative. It's also essential to recognize any assumptions we made along the way, the choices that influenced our conclusions, and to be aware of any limitations that could affect interpretations. As we close this notebook, we prepare for the next stage in our journey. The upcoming sections will likely delve deeper into the analysis we've conducted, perhaps looking to apply further techniques or methodologies that enhance our understanding of the data. Getting ready for what lies ahead can inspire further curiosity and exploration in the analysis of our findings.